This is the 2025 FOREX Trading Empire Mentorship Program Lecture 15. And the topic for this lecture is 3 a.m. to 4 a.m. trade setup. Now, in this lecture, I'll be talking about a specific setup, a specific time period where you'll be looking for a setup based off your higher time frame idea. Now, to use the 3 a.m. to the 4 a.m. trade setup, you need to understand that anticipating the next draw on liquidity, as explained in the previous lecture, is very important because that's where you'll be deriving your bias from, knowing where to anticipate the setup to form and where is price trading to. So you're still going to be applying the ways which was taught on the previous module on how to anticipate weekly bias, daily bias. So if I were to talk about daily bias, then I'll be talking about anticipating the next daily candle. So anticipating the next bias, you need everything to be in alignment and understanding the next draw on liquidity where you're only looking for an entry during this time period. If you don't have a clear perspective on where price is trading to during the 3 a.m. to the 4 a.m., you can't capitalize on those trade setups or you can't take advantage of the trade setups. You might be lucky a few times where the first fair value gap led to the direction, but to have that consistency and that profitability is understanding, is aligning it with your higher time frame and understanding that you are holding that trade for a long gap period to catch out big moves in the market. Because if you were to trade it without a bias, holding it up above 1 to 2 will be very difficult. Holding a trade above 1 to 2 will be very difficult because you be having low confidence in that trade setup, even if price were expecting the setup during this time period. So you need to align it and anticipate the next draw on liquidity where you're only looking for an entry. Remember, these are entry models. These are not biased and entry models. These are only entry models. You're only looking for an entry when your higher time frame bias is aligned with the 3 a.m. to the 4 a.m. trade setup. Now, at the 3 a.m. to the 4 a.m. trade setup, anticipate a 5 minute or 15-minute entry between 3 a.m. to 4 a.m. price range. Now, between this price range, you're looking for a fair value gap or an order block aligning with your bias. When I talk about trading specifically on an hour plus or between an hour, this is what I'm trying to talk about. Focusing on these setups, on these individual trade setups, on this price range setups. So the 3 a.m. to the 4 a.m. price range setups, you're looking for a fair value gap or an order block. In most cases, use a fair value gap because a fair value gap will give you more room and perspective and it's easy to identify because you know that a fair value gap is being formed by trade candle and if the fair value gap is aligned with your bias, you execute on the fair value gap. Even if the fair value gap occur before the 3 a.m., you can still execute on the fair value gap or order block because as long as your bias is still aligned with where you're anticipating price to trade to, so you're supposed to look the market before the 3 a.m. You're supposed to prop up, do your market analysis to know the next draw on liquidity, as explained in previous lecture. Then you're looking for an entry. So during that time, the fair value gap between this price range or a fair value gap before this price range, leading to a trade setup, aligning with your bias, you execute on that entry between the range of 3 a.m. to 4 a.m. price range. And make sure to have a bias before looking for a setup between the price range. If you don't have a bias, don't even look for an entry during this time. Although sometimes you might be lucky because there's a specific fair value gap that do occur due to the 250 to 3 a.m. micro, 250 to 310 micro, sorry. So between the range of 250 to 310 a.m. micro, there's a fair value gap that do occur during that time because price is going to be running out liquidity on lower time frames. So as soon as price is creating an expansion, creating a fair value gap, executing on that fair value gap is a high probability fair value gap. But if you don't know where price is trading to, you can capitalize on that fair value gap. So that's why it's better for you to have a bias. Make sure you have a bias before then, so that after the micro, you're looking for your entry during the 3 a.m. to the 4 a.m. Eastern Standard Time setup. So the time which is being used for this trade setup is the New York Eastern Standard Time. So I've talked about setting your trading view to the New York Eastern Standard Time so that you can easily identify the setups. Now, let's go to the charts because I talked about making it more practical. So let's go to the charts. So on the daily time frame of Euro USD, now the 3 a.m. to the 4 a.m. trade setup, it can be applied to any currency pair. As long as you understand what you're anticipating during that time period. If it's the London section, you're mostly going to be focusing on currency that do trade during the London section, like the GBP USD, Euro USD, the New Zealand Euro, pairs that has been correlated with the Euro that will trade best during that time. Then you can look for your setup during the range of the 3 a.m. to the 4 a.m. So if you're trading Euro JPY, you can still trade it. You can still look for your setup during that time. Mostly it's going to be a trend continuation setup, so you can still apply it correctly. Now we're going to talk about Euro USD. Now this is actually a trade that is about to hit profit, so I'm just going to be using it as an example because it's well aligned with the idea I'm trying to explain. So on the daily time frame of Euro USD, you can see the shift in market structure. Price traded lower, took out this sell side liquidity. Now I'm talking about bias, how I look for my bias before going into lower time frame to look for that entry during that price range. Price run out the sell side liquidity, traded back to the range between the swing high and swing low, failed to create a lower low. Now price did a high, creating a new high, running out this buy side liquidity, which I'm not going to be drawing out. I want the chart to be more cleaner. So price trade higher, run out this high, run out this high. During the price range for price trading higher, price left another block. Here's the other block. The last down close candle before the impulsive move. Now, you are using the idea from the swing low. This was the candle that created the lowest low, which if I were to go into lower time frame, this would be the candle that will be running out lower time frame liquidity, like the 4 hour and the 1 hour. So here's the other block, not this candle. This candle is an internal candle. It trades between the range of this candle swing high and swing low. So this is not another block. This down close candle before the impulsive move is not another block. If the candle would have swept out this previous day's low before leading to these higher prices, then it would have been the other block. But here's the other block. Now, price closed after running out this high. A retracement back to the other block, respected the other block. Price traded higher, did a retracement. Now, looking at the CRT, price running out this candle's low, did an impulsive move higher, getting close to this buy side liquidity. Prices were expecting the other block, leading to higher prices. Where's the next drawn liquidity? Buy side liquidity. Now, this is from a higher time frame perspective. Now, if I were to look for higher prices after this candle, this is a Friday candle, so I'm anticipating the next candle to create a new high, running at the previous week or previous day high because it's a Friday and this is a Monday candle. So running out the previous day high, I told you guys to always pay attention to your previous day high and previous day low. Now in this scenario, I'm anticipating price to run out the previous day high, which I'll be marking it as daily high. Now my next drawn liquidity is to see price run out the daily high. Even if price doesn't go for the buy side liquidity, but looking for the closest target, which is the daily high. Now, I wanted to talk about a scenario where you are anticipating higher prices, but price already traded from an order block, which in most cases it might lead to a retracement. Price is currently not on a high reference point, or let me say on a reference point that is indicating more higher prices. Price already respected the other block, created this high that took up this high. This is a retracement that failed to go lower to this fair value gap. Instead, price traded higher. So if price were to form another fair value gap within this price range from the from the swing low to swing high, then we'll be anticipating a fair value gap within this candle, which means we don't want to see price fill this candle completely to trade to this candle's high. If price were to do that, then we're not anticipating higher prices. So in this scenario where price is not coming from any reference point, already respected the reference point, which is this other block, I'm anticipating price to create a reference point. This is where you use lower time frame to your advantage. You use lower time frame like the 4 hour. You are looking for a fair value gap within this candle that price will respect, that will lead to higher prices for price to create a new high. I'm going to be using this example a few times, but these are what I'm trying to talk about of you guys going through every individual module and paying attention on the way I'm using the multiple time frame. I use this scenario where the next candle doesn't have a high probability of it trading to that high or trading to the next draw liquidity because it's not coming from any reference point. Price already respected the reference point. Now I'm trying to anticipate how far would the trend trade to. How far would the trend trade to? So I'm using lower time frame as my advantage to determine how far will price trade to. So let's go to the 4 hour. Now looking at this from a 4 hour perspective, price the retracement to a 4 hour fair value gap. Here's the 4 hour fair value gap. Price the retracement to this fair value gap. Now, price open, the new candle open, traded lower into the fair value gap. Price respected the fair value gap. Now price is trading higher to the daily high, which we'll be going through lower time frame to look at those specific time. We talked about the 3 a.m. to the 4 a.m. But now you understand the bias. I align the 4 hour and the daily time frame to determine price to run at the daily high as my next draw on liquidity. Price traded to a 4 hour fair value gap. I explain why I'm using the 4 hour fair value gap because from the daily time frame, it's just one candle trading higher. Since it's just one candle trading higher, I'm going into lower time frame to look for a fair value gap within that price range. That if price were to trade higher to run at the daily high, price will be retracing to that fair value gap. Putting more details into it, showing you guys how to align multiple time frames. These time frames are for you to get enough information from it. So going to the 4 hour, price retrace to the fair value gap, respected the fair value gap. Now we're going to go to 15 minutes, 5 minutes to look for our entry during that price range. We are anticipating higher prices because this is close to the London section. So if the London section is going to lead to higher prices, then we'll be anticipating our entry between the 3 a.m. to the 4 a.m. trade setup. Going down to the 15 minutes, let's go to the 15 minutes first. Now you can still use the idea I talked about on the how to anticipate daily bias from the 1 hour perspective. The opening price going for lower time frame liquidity. So here's the opening price. Price open below the opening price. You look for a reference point below the opening price. Both are still aligned. The 4 hour reference point is still a reference point. So here's the opening price. Opening price. Below the opening price, here's the sell side liquidity. Price open, traded to the sell side liquidity, traded into the 4 hour fair value gap. Now price is at a discount and we are anticipating higher prices or price to run at the daily high. Now this is the 1 hour time frame. So you can see the alignment of every individual time frame. Lower prices, running out sell side liquidity, 4 hour fair value gap, anticipating higher prices, and looking for a specific entry between the range of 3 a.m. to 4 a.m. And let's go to the 15-minute time frame. 15-minute time frame, price traded to the fair value gap, traded higher, retracement, higher, retracement, higher, retracement. Now here's the shift in market structure. 2 up close candle, running at this high, shift in market structure, retracement, order block. Now we are looking for an entry between the range of 3 a.m. Let's make this a little bit lighter. 3 a.m. to 4 a.m. So personally, the best time I use to enter during this time is during the 5 minutes. I like using the 5 minutes because it gives me more details on that 1 hour time period. But on the 15 minutes, the fair value gap is still there. So here's the fair value gap within that price range. So if I were to adjust this a little bit, you can see the fair value gap. Let's take this out. So the fair value gap formed between the range of 3 a.m. to 4 a.m. That was when the fair value gap did form. Retracement back to the fair value gap respected the fair value gap. So let's make this fair value gap blue. Price respected the fair value gap, traded higher, and this would have been your entry. Anticipating higher prices. Stop. You can just use the fair value gap stop, which will be more lower than this, but that's why I like to use the 5 minute time frame. It do gives me a better reward to risk ratio. So let's go to the 5 minute time frame. But you can see you can still trade directly from the 15 minute during this time, but try to look at on which time frame gives you the best and which time frame shows you more clarity on the setup, which in most times the 5 minutes. So on the 5 minute time frame, here's a 3 a.m. candle, price open, created a new high. Now seeing this swing high after the shift in market structure on the 15 minutes, price created this swing high, retracement to this fair value gap. Now this is your fair value gap for your entry. Anticipating higher prices, the first fair value gap between the price range is your entry that is aligned with your bias, not the fair value gap against your bias. As long as it's aligned with your bias, that fair value gap is your entry. Which this will be your entry level and your stop swing low and your target previous day high, which is a daily high, buy side liquidity, premium liquidity. You entered at a discount, anticipating higher prices. So you can see that the time frame, the time range is well aligned with your daily bias. It can still be, you can still use this on a weekly perspective, which I'll be showing more example on it once we get a trade review. These are just the basic of it. Knowing those specific times I'll be talking about, those specific times to anticipate setups that I'll be talking about. I've already talked about the Tuesday and Wednesday. Now we are going into more details and more in depth on those specific times. Most of them are around 1 hour 30 minutes. I think that's the highest I can show you guys. And when your bias is fully aligned, you'll be looking for a setup between those time range. Retracement, fair value gap respected it, run to the high. Price haven't traded to the high, but you can still trade your stop. And I know price was traded to the high, running out this high. I wanted to do the example after price running out the buy side liquidity or previous day high, but I have something to do, so that's why I'm trying to cover everything up. But this is during the London section. If I were to turn the London section indicator, during the London section, this will be your entry time frame, your entry range during the London section to look for your high probability setup. Now, during this time, sometimes there are not more than one setup, sometimes there are more than two setups or three during this price range. So you need to be ready to take advantage of it as early as possible. First fair value gap, retracement to the fair value gap, respected the fair value gap, created a new high, retracement to the 15-minute fair value gap, respected the 15-minute fair value gap, and you can see how price kept trading higher. Now we're currently on the New York section, and the New York section there's a setup between which I'm going to talk about. I'm not going to be talking about the time here, but there's a setup within this time range that will lead to higher prices or price to run this high. It's still an entry drive, which we'll be talking about in the next lecture. Yes, it's the next lecture. So take your time, do a back test on this. There's always a fair value gap during this during that time range. During this time range I'll be mentioning, but knowing a bias on where the fair value gap is going to be trading to is very important. You can see on Friday, here's the fair value gap around 310. Retracement to the fair value gap respected it and price trade higher. I can keep going on previous day, and there's a setup within that time range. But you need to know where price is trading to take advantage of the setup. So do your back testing on it. I hope you guys have been doing your back testing on the previous lectures. And you can add this, create the awareness of paying attention to this time range, retracement, fair value gap, and you can see how price kept trading higher. So having your bias, aligning it with the 3 a.m. to the 4 a.m. trade setup will give you the high probability setup, and it's giving you a lower time range to look for your entry. You just need your bias and your lower time range to look for your entry. So that's it for this lecture. See you guys in the next lecture.